Your neighbor is 70, retired. Most mornings there is coffee on the porch before you have even found your keys. Last year, you both made roughly $100,000. You handed the IRS $1,593. Your neighbor handed them $290. Same country, same income. One of you paid 50 times more in federal taxes than the other. That number does not make sense at first glance. It looks like a clerical error. It looks like someone found a workaround that the rest of the working population simply has no access to. There is no workaround. There is no error. The IRS code is functioning exactly as intended. The gap between those two tax bills comes down to a single distinction: how retirement income gets structured versus how working income gets taxed. Two different systems running in the same country, producing outcomes that look like they belong in different tax codes entirely. If you are 45 or 50 years old and this distinction has never been clearly explained to you, there is a reasonable chance you are working toward a retirement number that is 10, 15, maybe 20% higher than what you actually need, because every projection you have run is using a working person's tax assumptions on a retired person's financial life. Every 2 weeks, you open your pay stub. Above your net pay is a line item that has probably never generated any positive emotion whatsoever. FICA, Federal Insurance Contributions Act. Social Security tax combined with Medicare tax, 7.65% of every W-2 dollar collected before the money ever reaches you. On a $100,000 salary, that is $7,650 per year. Taken automatically every year for the entire duration of your working life. Most people accept this as a permanent condition of employment in America and stop thinking about it. It feels as fixed as the calendar. Here is what actually happens on the day you retire. FICA stops, completely, immediately. The moment W-2 wages end, Social Security tax ends with them. Medicare tax ends with them. The charge does not get deferred, reduced, or relocated to a different form. It ceases to exist because it is a tax on earned income, and earned income has left the picture. Social Security benefits carry no FICA obligation. Investment income carries none. Pension income carries none. The tax was always only designed to reach wages, and once wages stop, it has nothing to reach. That is $7,650 a year that your retired neighbor no longer pays, without any planning, without any strategy. The tax code simply stops applying to a category of income that no longer exists. The IRS has known this the entire time naturally. The information was always available, right there in the code, very prominently not advertised. Before the IRS calculates what you owe, it first agrees to ignore a portion of your income entirely. This is the standard deduction, a baseline shield that applies to every taxpayer. For a married couple filing jointly in 2025, that baseline is roughly $30,000. The first $30,000 of household income passes through the system untaxed before any rate is applied. At 65, that shield expands. The tax code includes an additional deduction for taxpayers who have crossed that age threshold. When combined with recent legislative updates aimed at reducing the burden on lower to middle income retirees, a married couple where both spouses are 65 or older can see their total shielded income exceed $46,000. The practical effect is significant. A retired couple with $46,000 in protected income reaches zero taxable dollars before their effective rate even starts calculating. The first $46,000 moves through the system without generating a single dollar of federal liability. A working couple at the same income level starts that calculation at $30,000. The difference, over $16,000 in additional shielded income, translates directly into taxes that the retired household simply does not owe. This is the result of reaching a specific age, which the tax code treats differently by design. Add that to the FICA elimination, and the structural tax advantage of retirement is already substantial before a single investment account enters the equation. There is a widely used retirement planning formula. Accumulate 25 times your annual expenses, withdraw 4% per year, and the math says you never run out of money. The formula itself is reasonable. The number most people plug into it is where things go sideways. The standard assumption is that retirement will cost roughly the same as working life, that maintaining your current lifestyle requires replacing something close to 100% of your current income. That assumption does not hold up when you look at where the money actually goes today. FICA takes $7,650 off the top before you see it. Federal income tax applies to the full gross amount. Commuting costs disappear. Work-related clothing, meals, professional memberships, and the assorted friction of maintaining a career. All of it stops the day the career stops. A meaningful portion of your current paycheck is funding the overhead of earning, not your actual life. When retirement income is structured correctly, most people need somewhere between 70 and 75% of current gross income to maintain the same actual standard of living. The taxes lighten, the work expenses vanish, and the gap between what you earn and what you keep narrows considerably. If your retirement target has been calculated on full income replacement, you may be chasing a number $500,000 to $1,000 higher than necessary. That translates directly into years of working life spent pursuing a finish line drawn in the wrong place. The financial industry does not have a strong incentive to make this correction for you. A higher target produces larger account balances, longer contribution periods, and more assets generating management fees. The math on their end works out quite well with your anxiety in place. There is a federal tax rate on investment income that most working Americans have never had access to, and most retirees do not realize they qualify for 0%. Under current IRS rules, long-term capital gains, profits from selling assets held longer than 1 year, including stocks, ETFs, and index funds, are taxed at 0% for taxpayers whose taxable income falls below a specific threshold. For a married couple filing jointly in 2024, that threshold is $94,050. In 2025, it rises to $96,700. Below those figures, an investment that has doubled in value can be sold, and the federal government collects nothing on the gain. Consider what this looks like in practice. A retired couple draws Social Security income that falls mostly inside the expanded standard deduction. They take a careful, measured withdrawal from a traditional IRA, keeping the combined total below the key thresholds. They also hold a taxable brokerage account built over 25 years of consistent investing. Index funds accumulated since their mid-40s, sitting on substantial, unrealized gains. They need $20,000 for a home renovation. They sell positions from the brokerage account. Capital gains rate on the transaction, 0%. Federal tax owed, $0. This is not aggressive tax avoidance. The 0% capital gains bracket is in the tax code precisely for this income range, and a well-structured retirement can keep income inside it year after year. The working version of you pays ordinary income rates on every dollar. The retired version of you with the right structure in place can draw from appreciated investments and owe the federal government nothing on the gains. Same IRS. Completely different outcome. The difference is entirely structural. A lot of people hear that analysis and arrive at what feels like an obvious conclusion. Maximize the 401k contribution, let it compound over decades, and deal with the tax details closer to retirement. The upfront deduction is real. The tax-deferred growth is real. Eventually, you land in a lower bracket anyway. That logic is internally consistent. It is also the logic that produces retirement accounts with no flexibility in tax bills that arrive as a surprise. There is a version of retirement where every box on the conventional checklist has been checked. Consistent contributions, employer match captured, balance hitting the target number, all of it done by the book. And the tax rate in retirement is still higher than expected because every dollar accumulated ended up in the same type of account. And when income only flows from one source, the only variable is how much comes out. The rate is whatever the bracket says it is. There is no negotiation available. Picture someone at 60 with $1.5 million in retirement savings. That is a real number. For most working Americans, that balance would produce genuine relief. Every dollar of it sits in a traditional 401k. When a large expense arrives, a medical bill, a roof replacement, a vehicle, the only move is a traditional 401k withdrawal. That withdrawal lands as ordinary income. It stacks on top of Social Security. It determines the tax bracket. It determines how much of Social Security becomes taxable. And it determines, with a 2-year delay, what Medicare is going to cost. One decision, 3 financial consequences. None of them visible during the decades the contributions were made. The traditional 401k performed exactly as designed. It just was not designed with your retirement flexibility as the primary objective. Most people are aware that Medicare carries a monthly premium. In 2024, the standard Part B premium sits around $174 per month. Fewer people are aware that Medicare also operates a surcharge system called IRMAA, the income-related monthly adjustment amount, that can push that premium significantly higher depending on income and does so on a timeline that makes it nearly impossible to anticipate in real time. In 2024, a single filer whose modified adjusted gross income crosses $103,000 sees Part B premiums jump to over $200 per month. Cross the next threshold and the number climbs again. For married couples filing jointly, the thresholds are wider, but the mechanism is identical. The detail that catches most people off guard: IRMAA is calculated using the tax return from 2 years prior. The income that triggers a premium increase is income that was earned and reported in a year that has already passed. By the time the surcharge shows up on a Medicare statement, the window to restructure the income that caused it has been closed for 2 years, and the income figure that matters, MAGI, modified adjusted gross income, is different from taxable income. A large traditional 401k withdrawal flows directly into MAGI, regardless of what deductions due to taxable income. It is entirely possible to owe zero in federal income tax for a given year and still receive an IRMAA surcharge notice, because the withdrawal moved MAGI across a threshold that deductions cannot offset. A single withdrawal made out of necessity can produce elevated Medicare premiums for the 2 years that follow. The original financial need has been met, the Medicare statement keeps arriving. A Roth withdrawal does not appear in MAGI. A long-term capital gain inside the 0% bracket does not trigger IRMAA. The account type is the variable. That is worth knowing considerably before the withdrawal decisions begin. There is a dimension of retirement taxation that receives far less attention than it deserves: the structural difference in how the tax code treats a married couple filing jointly versus a single filer. The gap between those two categories is substantial, and it shows up in multiple places simultaneously. The standard deduction for a single filer in 2025 is roughly half what a married couple receives. Tax brackets are narrower. The income thresholds for capital gains, for IRMAA, for Social Security taxation, all of them compress when the filing status changes. The 0% capital gains threshold for a married couple filing jointly sits at $94,050 for 2024. For a single filer, the equivalent threshold is approximately $47,025. 2 retirees, same investment account, same gain realized on the same sale. The married filer owes 0 federal tax on the transaction. The single filer owes capital gains tax. That outcome reflects nothing about financial discipline or planning quality. It reflects a structural difference in how 2 tax filing categories are treated, a difference built into the code that does not adjust for personal circumstances. For anyone who is widowed, divorced, or has always filed as a single taxpayer, the retirement projections need to use the correct thresholds. Running the numbers with married filing, jointly assumptions when the actual filing status will be single produces a plan that will underperform its projections quietly and consistently over time. At age 73, the federal government begins requiring annual withdrawals from traditional pre-tax retirement accounts, traditional 401ks, traditional IRAs, the accounts where the majority of American retirement savings have accumulated. This is the required minimum distribution. The amount is calculated by a formula the IRS publishes annually based on account balance and life expectancy. There is no negotiation, no opt-out, no deferral mechanism. The withdrawal happens, and every dollar of it arrives on the tax return as ordinary income. For someone holding $2 million in a traditional 401k at age 73, the required withdrawal lands somewhere between $75,000 and $80,000 for that year, regardless of whether the money is actually needed. That figure gets added to Social Security income, gets added to any other sources. The combined total sets the tax bracket, sets the Social Security taxation rate, and, 2 years forward, sets the IRMAA surcharge level. People who directed every retirement dollar into a single pre-tax account are not making income decisions at 73. They are receiving a government-issued schedule and organizing their financial life around it. The contribution to the traditional 401k felt clean throughout the working years. Lower taxable income, more take-home pay. The employer match on top. The cost of that arrangement does not appear on any statement during the accumulation phase. It appears at 73 when the schedule arrives, and the flexibility that was never built turns out to be the thing that mattered most. One group spends those years managing the consequences. The other group has options. The size of the balance is the same conversation. The structure of the balance is a completely different one. Imagine two people reaching retirement in the same year with the same net worth, 1.8 million, every variable identical except one. The first person has $1.8 million entirely in a traditional 401k. Every dollar pre-tax, every dollar subject to ordinary income rates, every dollar counted in May GI at withdrawal. Every dollar sitting inside the RMD calculation at 73. The second person has $600,000 in a traditional 401k, $700,000 in a Roth IRA, and $500,000 in a taxable brokerage account holding long-term index fund positions. Same net worth, same number on the statement. In a given retirement year, the first person needs $90,000 to cover expenses. The only available source is the traditional 401k. That $90,000 withdrawal lands as ordinary income, stacks on Social Security, pushes into a higher bracket, feeds directly into MAGI, and potentially triggers IRMAA for the following 2 years. The second person looks at the same $90,000 need and has an actual decision to make. Draw $30,000 from the traditional 401k, enough to stay inside a manageable bracket. Pull $40,000 from the Roth, tax-free, invisible to MAGI, no downstream effects on Medicare or Social Security. Take $20,000 from the taxable brokerage. Long-term gains inside the 0% threshold, zero federal tax on the transaction. Total income drawn, $90,000. Federal tax on the Roth and brokerage portions combined, $0. Total tax exposure, a fraction of what the single bucket version generates on the identical need. Same net worth, same lifestyle being funded. The difference is not how much was saved. It is how many options were available when the income needed to be drawn. Redirecting savings away from a traditional 401k and into Roth accounts and a taxable brokerage has a real immediate cost. It shows up in the current year. Roth contributions do not generate an upfront deduction. Every dollar going into a Roth is a dollar the traditional 401k would have sheltered from this year's taxes. In the 22% bracket, a $10,000 Roth contribution costs $2,200 more in taxes this year compared to the traditional alternative. That cost is real. It is also the price of flexibility, the ability to manage tax exposure in retirement rather than having it set by a withdrawal schedule written by someone else. Between 45 and 55, the compounding periods are long enough and the contribution windows are wide enough for all three buckets to accumulate into something meaningful. The structure can still be built. The choices are still available. At 62, looking at a retirement account that is 95% traditional pre-tax, the path to restructuring runs through Roth conversions. Converting balances in a year when the tax rate is manageable. That process works. It is also more expensive and more constrained than simply building the structure earlier. The cost of building the right structure now is a known manageable number that shows up on this year's return. The cost of not building it is an unknown that arrives later, in the form of mandatory withdrawals on a schedule you did not write, Medicare premiums you could not anticipate, and tax bills that land above the bracket you expected to be in. Tax rates will change. The code has been rewritten repeatedly over the past century, and there is no structural reason to expect the next 20 years to differ from the previous 100. Congress could raise ordinary income rates, could reduce capital gains rates, could restructure Roth treatment, could adjust or eliminate IRMAA thresholds entirely. Anyone presenting a confident projection of the tax environment in 2040 is working from assumptions, not knowledge. That includes the people charging for the projection. What the three-bucket structure provides is not certainty about future rates. It provides options regardless of what those rates turn out to be. If ordinary income rates rise sharply, Roth income is already permanently sheltered. If capital gains rates rise, the brokerage bucket becomes less advantageous, but the Roth absorbs more of the load. If rates fall across the board, all three buckets benefit. The mix can be adjusted annually based on whatever the actual tax environment looks like in that year. A single bucket retirement has one variable: how much comes out and what the current rate charges on it. A 3-bucket retirement has options. Flexibility is the precondition for every tax strategy. It gets built during the working years. It cannot be manufactured after retirement begins. Go back to those 2 tax returns, 15,393 and 290. Same income, same country. A gap of over $15,000 in federal taxes paid in a single year. That gap did not appear because one person was smarter or luckier or had access to something the other did not. It appeared because of decisions made during the accumulation years about which accounts received which dollars, decisions that created either a single mandatory income source or a set of options that could be drawn from selectively based on what each year required. The mechanisms behind the gap are specific and traceable. FICA, $7,650 in annual taxes that disappear the moment W-2 income stops. Standard deduction expansion past $46,000 after 65, thousands of dollars of income shielded automatically. The 0% capital gains bracket at $94,050 for married filers. Investment gains that travel through the tax system without generating a bill. Roth withdrawals that do not touch MAGI. Income that is invisible to the formulas that trigger IRMAA and Social Security taxation. It is not necessarily the direction that serves you best at 73. That is not one decision. It is a decade of small decisions made consistently that compounded into a completely different tax reality. Here is the one concrete action worth taking tonight. Open the retirement account app. Pull up the summary screen. Look at the percentage of total savings sitting in pre-tax traditional accounts versus everything else. If that number is 90% or higher in traditional 401k or traditional IRA, that percentage is the starting point, not a verdict. A starting point. The next dollar that goes in does not have to go where all the others went. That is the decision. That is the whole blueprint. The neighbor paying $290 is not smarter.